everyone, and welcome back to the Saltation Podcast. Today, we have a special guest with us to talk kind of all things California and learn about what they're doing, what some stuff has been pushed out as our, one of our more populous states. We have a lot to learn from our guests. So, Michael, if you want to kind of give us an introduction, we'll get right in.
Absolutely. Thank you, Meredith. Thank you, Stacy. So my name is Michael Cataldo, and just a little background about myself. I graduated USF Law School in 1999, went to NYU to get my LLM, which I completed in 2001, at which point I became employed by the Franchise Tax Board in their legal division and stayed there for about 3 years, and I went on to Big Four accounting and worked at Ernst & Young for 3 years. Mainly, I was doing consulting work and memos and whatnot at Ernst & Young, and then later became more compliance, which led me to then depart because that was really not my cup of tea. And I went over to a big law, Pillsbury, Winthrop, Shaw Pittman, their law firm and their salt practice. And I was there for a little over 12 years. And then in 2018, I started my own practice, Cataldo Tax Law, which is where I am now, doing largely the same thing, which is mainly California income franchise tax as well as sales and use tax. But my practice is and has always really been multi-jurisdictional. So I take matters in any state. And then there's also the local issues. San Francisco is a big one, Oakland, and then also some property tax work.
Yep. We as Colorado residents love those locals.
That's right. We're very familiar.
Oh yeah, I'm sure you are.
On a different scale,
right?
I don't have the nightmare you have. No.
Yeah, it's a different nightmare.
Like California's got San Francisco, Oakland, Los Angeles. Mm-hmm. Those are like the main local ones where there's a lot of controversy on their local like gross receipts taxes. Mm-hmm. Property tax disputes are also local as well. So those are all over the place, depending on property values.
Right, which, in California are really low. So I don't understand how it could be material at all.
Yeah, not to mention all of the crazy rules for assessments and Prop 13. Trying to keep your base year value low is a big one, which is unusual for folks outside of California to see.
All good stuff. So with that, with that range of experience, right? You've got franchise tax board, you've got public accounting, you've got private law practice. Do you find that kind of throughout the span of your career and kind of focusing, being based in California, for seems like a large chunk of your career, if not the whole time, do you think there's just like a reoccurring thing that keeps coming up with the FTB and in the state, or is it just kind of all over the place, or, do they like to pick on something in particular, or is it kind of what's on top of the mind at that moment?
Well, and this is probably speaks to just the multi-state practice in general, but over the years, there's been sort of this gradual shift where my clients used to be mainly located in California, and now more and more of them are located outside the state. It's like my old clients are like, yeah, California's great. I pay nothing now with all market-based sourcing. All my stuff is out of state. Don't really need you that much anymore. But hey, I got a friend who's got a business in New Jersey or New York or somewhere else, and California's knocking on their door, and all of a sudden their bills are a lot higher. So this big shift in multi-state practice because of this, really sort of exporting the tax revenue to out-of-staters. But as far as like FTB's favorites, I don't think that's really changed a lot. Residency is a huge one. California's personal income tax rate is sky high. And then when you consider that there's no special rate for capital gains, California becomes almost as significant as federal when you have a large transaction. So there's an incentive to sever residency for these large transactions. And FTB is all over that. And then there's always the secondary issue with residency as well. How about source? Because if you're a non-resident, perhaps this massive gain has a source in California. So they're big on that. Unitary determinations for the corporate folks. That's a pretty hot area as far as activity. And I really think we're just starting, and it's going to overwhelm. It's going to be the main thing, if it isn't already, is sourcing sales of other than tangible personal property under market-based sourcing. The main reason is we have a single sales factor in California, have an not even economic, factor presence nexus standard, which is triggered based on sales. So you're looking at these market-based sourcing rules, not only to determine what your apportionment percentage is, but do you even have a filing obligation? And the answer is not always clear under the rules and guidance that we've been given. So a really huge issue is market-based sourcing, because not only does it determine nexus, and you owe zero. Do you have a 0% or maybe 100%, depending on how you interpret a particular rule, or anywhere in between. So that's where I see it going.
Yeah, which is not too uncommon from what we deal with, and then kind of wrapping those all into one. We, especially then when you're dealing with kind of humans on the opposite end of that versus corporations, when we have a client who has kind of a really unique business that is doing really, really well. They're a pass-through entity with unique set of facts, where their customers are insurance companies, right? But insurance, if it's State Farm based in Bloomington, Illinois, is insuring houses in California, it's not Illinois that's getting that benefit. It's actually the residents in California, where the policyholders are, that, this company supports. So there's that sourcing challenge, but then it's flowing up to an individual who's a non-resident, but also paying tax at 12.3%, or just shy of that, based on, the ratios of federal AGI and all that nonsense. So we have, those are kind of those top three, all, nicely packaged to one of our large client. Human clients.
Right.
Yep.
Right.
Yeah. And there's a lot of folks like that. I don't know if you're familiar with this Metropolis case that just was released by a court of appeals in California, which talks about just that, as far as like business entities' income flowing up into ultimately what is an individual taxed under the personal income tax laws. And the personal income tax laws have a rule. It's the Mobila rule. It says you source gain from intangibles to the state of residency. But in this Metropolis case, the gain was the sale of business at the S Corp level. And what the court held was that, hey, we look at the apportionment at the S Corp level, and whatever California apportioned income at the S Corp level flows through to the individual and becomes California source income for that individual. The taxpayer argued this was an intangible income, because almost all the gain, I believe, was from the sale of goodwill, which is an intangible. Well, the court didn't agree and said you just basically flow it through. Apportionment equals California source income for non-residents.
So was that case more decided on, or maybe a combination of sourcing and unitary rules?
It didn't go up on unitary. You have to have a unitary business to apply any of these rules, but there was no question that there was a unitary business. It was the Pabst Brewing Company. So they were, a pretty large international corporate taxpayer, and they had a lot of activity in California. But there's been, and FTB has been fighting this fight since before I was even at FTB. And there was a State Board of Equalization case, Venture Communications, where the State Board of Equalization came out the other way, but it was an unpublished opinion, and FTB didn't like it. They actually promulgated regulations contrary to it, and litigation ensued. Here we are, almost 20 years later, more than 20 years later, probably, since they've been fighting this. And now we finally have resolution, although we don't know if they will seek review by the California Supreme Court, which is a possibility, and they may overturn. But there is now a published Court of Appeals decision on this issue.
Yeah, which is contrary to kind of what the other big kind of pass through holdings, the vast holdings out of Massachusetts, within the last couple of months, but it was different set of facts, right? It wasn't gain reported at the S Corp, it was gain reported at the shareholder level, and whether or not it was Massachusetts source gain. And again, kind of looking at the unitary principle kind of that they focused on, as Stacy had mentioned. So just, it's always funny. And it seems like here recently, maybe people, or it's more publicized or what, that people are really paying attention to, right? It's always an issue. It's always been a pain for us as practitioners of like, well, what are we going to do with this giant occasional gain, right? To like how we're going to treat it correctly, especially again, from pass-throughs, a lot of it has to affect humans, right?
Yep.
And so it's a lot, the emotional attachment to writing a $12 million check from a human is much different than, a corporation or like a business entity writing a $12 million check.
Oh, yes, absolutely. Absolutely. And, this is such a common area for me is the business, non-business income. So it's very frequently the cases I get involved in start with a sale of a company where you get a ton of gain.
Mm-hmm.
And it used to be a little more debatable, and it's still not completely decided. But I mean, what is it, business or non-business income? You have to look at that question. Perhaps there's a chance you can say it's non-business income, in which case you would source any gain to the commercial domicile of the seller. But we have the functional tests, which is pretty clear now. And so then you got to look at, well, was this a unitary business? Maybe the connections with California or whatever state you're debating, there's a different unitary business. Maybe, hey, this is a separate unitary business from the unitary business being conducted in California. And you can't tax the gain from one unitary business based on factors of another. So those are big issues. They come up. And then the second part of it is, okay, so perhaps it is business income now. How do we assign the gain? And then we kind of fall right into the apportionment regulations that they have now on market-based sourcing, and looking at how did you apportion, what was your apportionment percentage in the year of sale? Okay, well, that's how much we're taxing you. And lastly, and this is every time, it's like a matter of practice when you have a substantial sale and there's an audit, it's like you really need to quickly look at the other states. What happened in the other states? Is there refunds sitting there perhaps? Did you overpay? Maybe if you truly believed it was non-business income and you paid 100% of the tax on the gain to your stated commercial domicile. Now you're getting audited by California or another state saying, hey, this is business income. We're going to get our cut of it. Well, you might want to file a claim with the commercial domicile state before the statute of limitations on refunds expires. Then you're really just set up to pay double tax. So that's like the first thing I do is where else have you paid any amount of tax? What was your position? Let's make sure we're protecting you. I mean, sometimes I've gotten involved in a case where I was like, oh no, we're getting hammered with this business income case. And then took a look at all the other states and we turned what they thought was getting hammered into something nominal in the end. When you look at the aggregate, all right, well, we'll get refunds here and there and there. And okay, so maybe we can negotiate here and not totally win, and you kind of mitigate the potential damage.
Yeah. Well, and, almost trying to explain that concept of business income versus non-business income to the unknowing. It's like, but I'm not in the business of, I don't know, selling land or whatever, but it's like, okay, fine. Right. But did you use that land in order to create all of your other business income? And it's almost a given that if you call something non-business income, you will be audited. Like 100%.
There's a lot of money there.
Yeah, exactly.
One of my first this still like haunts me to the day. I don't remember what I was doing, but I accidentally put a gain on the wrong line as an adjustment on the return, and it didn't get caught. This is like over 15 years ago, I think. And it came out as like non-business income and automatically got audited by the state of Montana, which generally isn't one of those well-known states to, pick on someone. But because I had that gain on a non-business line, we got audited, and this stupid thing like carried on for like 2-3 years because of just like a mistake. So it's like, I always am hypersensitive to that, like business, non-business kind of just classification.
Or
Yeah, well,
presentation, right?
Or, yeah,
that was right. That was
a
just,
whoopsie.
that
Well,
was
yeah,
it.
that was a whoopsie.
Right.
it's funny
But
you
it
mentioned
happens.
Montana because I just had a Montana case wrapped up on business, non-business income. And that was quite a challenge. We ended up settling at a really, really good rate, but they were very aggressive. They saw non-business income and they were full guns blazing. Allied signal never happened. Everything's business income. There's no such thing.
Wow.
Case law there that actually they had the Supreme Court case, Montana Supreme Court case. It was Ward Box Company, and it ended up going to the U.S. Supreme Court at the same time as like the Woolworth case, and then and a couple of others. And then those cases said, hey, there is a limit. The unitary business principle does limit states' ability to tax. Sent back down, and they said, oh, but you admitted it because you filed this way in other states. That was the end of it. Now you've got the Supreme Court case, which is, they say is, everything's unitary. But in any case, we settled at a good rate.
We settled too on that one. Because what also is really trippy is kind of in California, it's got that, is that kind of the distortion rules, right? Where, but it's an apportionment concept where it's like you can pull it out of your factor, but then you still have the gain in your business, in your tax base. So it's like you're kind of getting, it's not equal representation, which is really frustrating.
Yeah, I mean, and these issues come up all the time, and there is room to argue about it. Now, California has their rule and their regulation where substantial and unusual sales are thrown out of the sales factor, but the income is still in there. Mm-hmm. The question is, hey, is this a fair reflection of income? Mm-hmm. Sometimes it's not. But I mean, the regulation applies. It's a regulation under 25-137, which is their alternative apportionment statute. So now that it's a final regulation, it's as if this is the regular rule. But you can challenge that regular rule under alternative apportionment to say this is not fairly reflecting what's going on.
Right.
Factor representation. It's similar to the notion of getting dividends from foreign companies. The dividends just in. Well, can we get some? No, we're just going to tax that based on the apportionment. That has nothing to do with the dividends. That doesn't really fly. There's definitely a lot of arguments and room for getting representation in the factor.
Well, I kind of want to take a step backwards because I feel like we've had, even all through my career too, like questions about just nexus in general, right? And a lot of, and myself included, a lot of practitioners, clients, taxpayers will look to kind of California's rules to say, okay, what are they saying? Because there's a lot published, right? Mm-hmm. And that can be good and that can be bad. So I think one of the things that I've had a lot through my career as a state and local tax practitioner, and I've got, I've had other people call me, or, we've been brought in certain situations to say, okay, we think we have nexus in California because we've exceeded the $500,000 rule, or we know that it's indexed for inflation. So you started out 500, it's, gone up over time. But I'm not always so sure that that's really something to hang your hat on, because I feel like it's a little bit of a trap for the unwary, the doing business standard. And so I just would love to get your thoughts on that, because I feel like, if you're registered, done. Obviously you're doing business. Or if you have these, if you meet these bright line, done, you have nexus. Or if you're just otherwise, doing business in the state. So I feel like that kind of otherwise deriving or otherwise doing business is a real trap for the unwary. So I'd just like to get your thoughts on that.
Yeah, I mean, I think you hit the nail on the head. There's 3 ways you're done.
Or you're just kind of done, regardless, right?
Yeah, one is by virtue of qualifying with the California Secretary of State. So you're just coming Now you have filing obligation. The other is you hit the thresholds in the factor presence statute. It's 23.120. There's A and B. A is what the old school nexus, basically. And any transaction for pecuniary gain or profit in the state creates nexus. The State Board of Equalization interpreted that provision to require physical presence. Then there's B, with presence nexus statute. So you can have, property, payroll, or sales in the state exceeding the amounts. And it's almost 700,000 now. It started at 500,000. So you can have them in any of those ways. So you may have less than 500,000 or whatever the amount is of sales in California, but you sent a sales representative to California. Now you got it under A, the old school way, because there's Scripto and Tyler Pipe, these classic Supreme Court cases that say it doesn't matter if they're employees or independent contractors. If they're there to establish or maintain a market, then that's sufficient to create nexus. So, and then another thing to think about, and this is where it gets, I don't know, you're having to explain it to humans, is when you have flow-through entities. And flow-through entities, it's just, hey, you know what? We're going to flow through your California source income all the way till, not quite till you get to a person, to entities. And those count towards your sales factor number. So now, but at the end of this, you've got a person there. Say it's an S corp, or it could be an LLC. At the very end of it, it's an individual. And here's your tax bill. You have all these entities have nexus. Why? Because the lowest one had it. The lowest 501,000, and your share of it is 501,000, all the way through. And then the individual who is not even subject to these nexus provisions pays tax because FTV's view, and it's in the statute. If you have California source income as a non-resident, you pay tax. It doesn't really address, hey, you might have some due process arguments for not. It just comes out and says you have California source income, you pay tax for individuals.
Yep. Which is also kind of an interesting, because at some point, there was the opportunity to say, okay, yes, I exceeded California's factor presence rule. Let's say we're truly a remote seller, right? We have $700,000. We'll adjust that number for inflation. We'll claim 86,272 and not pay income tax. Here's your $800 and we'll just move on. But then now you have kind of that quote unquote modernization of 86,272 from the MTC perspective. And California, I believe, was the first jurisdiction to kind of glom onto those new changes or modernizations or whatever you want to call them, pain in the butts. In their TAM from earlier this year, that kind of even negates the ability to hang your hat on 86,272 if you essentially operate a website.
Yeah, you really, and I think there's going to be more to come on this, and whether it's going to be through audits and appeals or other rulings. You got to remember these TAMs, legal rulings, chief counsel rulings are FTB legal staff's views of the law. So their guidance and their views, but they're not the law. There's a lot of debate about whether this MTC project holds any water. Is this, can you change what is stated in the federal statute? I mean, their argument is we're just interpreting it. It's always been this way, but the world didn't have the internet when they made it.
Right.
What about now it's here. So they're going to have to refine, and the states, California included, all the states are always a step behind technology, maybe more than a step, a couple steps behind. It's like, hey, if you get stuff via email, it's like you might as well say fax. I mean, where are we now with this? What are they possibly going to be eliminated in the future? And we have something else, and now we're like, oh, cookies. Well, we don't have cookies because they don't exist anymore. But really, what they're looking at, the things they say as far as the website is, okay, they piggyback off of what Wayfair said about virtual presence. They say, hey, that's a good idea. Let's use that sort of thinking with the federal statute that limits a state's ability to impose an income tax, even though Wayfair was a sales tax. But that gave them the idea, and they went through, and at the MTC, I mean, there was, over, a couple years of back and forth about what we're going to do. And California came out, New York's got their draft regs that are about to go final, pretty much what the MTC said. And you look at it, and they're looking at, okay, is there an FAQ button where you can talk to someone live chat? Like, if I email someone directly and ask a question and get emailed back directly, that doesn't seem to fit. There's a little button on the website I click that creates an email that suddenly becomes activity in the state. And to me, that's the big challenge for all of the states that are pushing this is, are these things that are done over the internet sufficient to be activity within the state for the person viewing it? I don't know. It seems like a stretch to me, but maybe not. Maybe it works. And I'm not hammering the desk on either side, because there's also folks who may benefit from this. And that would have been getting throwback sales to their sales factor now. And FTB even mentions this kind of in the TAM, second to last paragraph. Hey, you know what? PL 86272 protection also required you to throw back your sales from California to these states because PL 86272 protected you. But now with this new interpretation, I think it'd be very difficult for FTB to, go away from it in a throwback case. They might try to distinguish it on the facts or say you didn't get it on the facts, but there's some throwback and statute of limitations on refunds. So anyone with substantial throwback should be looking at their website, looking at how much they did throwback, what years are still open, how much is there possibly to claim a refund based on this new position.
Now, does California take the position that you have to file a return in order to avoid throwback? Or are you just subject to tax whether or not you have to file a return?
In the other state, you don't have to file a return. It's just it's a jurisdictional standard. So it's under the Constitution or PL 86272. Do they have the ability to impose this on you? Not whether they do or not. So sales into Nevada are not automatically thrown back to California if Nevada could constitutionally and consistent with federal law impose an income tax.
Yeah, and I kind of am throwing the question out there just from, Illinois has their throw out provision when it comes to the sale of services, but their statute, I think, says like file a return in order to avoid throw out. And we're just showing how bad Meredith is at her job this hour.
No.
I got nailed on an audit kind of when I was a young practitioner on kind of that throw out provision of the sale of services, where we really also got kind of screwed is that they were US sales, but to foreign jurisdictions. And so those got thrown out. And that was basically 50% of our factor. And we couldn't prove that we were paying like that or anywhere else, but was also really obnoxious because that they were a Colorado based company. And it was prior to when Colorado went to market-based sourcing. So under their ratio of cost test from a service perspective, we were sourcing like 98% of our services to Colorado, but also got nailed on throw out in Illinois because like our destination sales weren't, it was unpleasant.
Sounds like for alternative apportionment. I want to get
our auditor
apportionment on it.
Our auditor was also a robot that like didn't use the bathroom, didn't drink water, and didn't leave like the office that we had him set up in. And so they were just like, we sold the company. We just need this to go away. But it has so happened that like, it was not fun in an income year, but also they had losses on the subsequent years. So we did kind of offset some of that benefit, but the company was just like, make this guy go away. He's awful.
Yeah. It's like that all over. Sometimes you just got to stick with it and move on to the next person. They're not going to help you out or see the light.
Yeah.
Got to have a client willing to want to do that too.
Yeah. They were just like, make it go away. I don't care. It's like $100,000. We just
Write the
sold our
check.
company for like $100 million. I don't care.
Yep.
Like,
Write the check.
it's one state.
So, Michael, you know, when you were talking about alternative apportionment, I mean, for the viewers, I guess, what does that entail to, let's say that, you know, they were like, hey, you know what, I'm curious about this alternative apportionment. Do we need to petition the state for that? What is kind of the procedure for that? And I know it can vary by state.
Yeah, I'll just tell you California, and I think California's got more rules on this than most states, but it's not too far off. Usually you have to ask. And you know, I'll just describe it in a manner I just did, actually. So the not unusual fact pattern of a sale of a business, that business was a unitary business conducted throughout the United States, including California. Historically, it filed in California with about a 10% apportionment percentage. Then in March of the year, they sold their company in March. So all of the assets are sold, but there was one set of assets that could not be sold until there was approval granted by a certain agency unrelated to tax in California. So they had to continue to operate that portion of the business until they got that approval, which they did get in September. So this client took a position that the gain was just non-business income. But they did allocate some amount to California. They filed a return and paid a little bit of tax. They got audited. The auditor said, this is business income, and here's the tax. The apportionment percentage in the last year, which is the year of sale, was 35%. Why did that happen? That happened because this very unique situation, which was that the entire business was sold except for this small portion. This small portion was exclusively in California. So it was running its business, jacking every sale that came in was a California sale. And as a result, and we also had records quarterly to show, hey, the first quarter of the year of sale was consistent with prior year's apportionment of about 10%. Now we're jacked up to 35% because we are looking only at or for most of the year, we're looking at exclusively California. Now you, California, the auditor, are apportioning this gain on the sale of the entire business. The gain was developed over years of time with the apportionment percentage of the years back. It's always a test case. Like I always take a look just for, is this right? What was your apportionment in the years of the value of this company going up? Clearly here, 10, 10, 10, 35, what? So explain this to the auditor. The auditor was just like, no. Okay, well then I'm going to make, and the auditor understood that she didn't quite understand, which was fine because there's a procedure in place. You file a petition for alternative apportionment, which we did. And there's an alternative apportionment committee at the Franchise Tax Board who reviews alternative apportionment requests. You have a hearing, which I had a hearing, about 30 minutes of a hearing. And in this case, we got a result, which was, you're right, in about 2 weeks, because come on, it is pretty obvious here that it's an overreach and misunderstanding. So that is really the process. Now there's a whole set of proposed regulations, which it's so narrow, I don't want to even talk too much about it, but it's the process and the procedures for, like, if the committee found against my client in that case, I could then request that the full Franchise Tax Board, as in the 3 people who are on the board, hear the case. Mind you that their legal advisors are the ones who just made this decision, but nevertheless, there's this, it's in the statute. Statute says the board will review, so then you can go to the board and ask them to review. And there's some detailed procedures and briefing and whatnot with that. I would very rarely ever use that. I really just very rarely would. There's been a few who have tried. Philip Morris is one, for example. So they went and they took their petition. They didn't want a single sales factor. So they were challenging the single sales factor as distortive. And they said, all right, well, we want not just a evenly weighted 3-factor formula, but we want a 4-factor formula, and we want to double weight the property factor. Of course, they're all in Virginia. So that right there kind of tells me, okay, you don't really have the numbers to get it, because that just sticks out as kind of odd. But they took it to the board. The franchise tax board made their argument, which to me, one of the things that was just telling, I guess, is they said, okay, fairly reflecting income. The single sales factor does not fairly reflect income, says the taxpayer, because it doesn't count whatsoever all of the property and payroll required to generate income. And the FTB's response before the hearing, this is all public information, is that a fair reflection of income is the market. That's what the legislature said, so that's what we're saying. And of course they lost, but you don't get like an opinion or anything as to why. It's perhaps, hey, you know what, you just didn't have the numbers to show the distortion, because you have to show distortion in the regular formula. You have to prove that. And it's a pretty high bar. Like, oh, it's just off a little bit, it's not going to cut it. And under the law, they looked at all of the case law, and there's quite a bit of case law on distortion in California. It was like the numbers were not working out, so they needed to double the property factor to get there.